To everybody, and good morning if you're on the West Coast. This is McQueen Financial's Investments 201 webinar. Welcome, everybody. Thank you for attending. Couple of administrative things I wanted to mention. At the bottom of the yours page, there is a Q&A. Is that right? It's a Q&A or the chat, either or, right? And if you have questions throughout the webinar today, please feel free to make those entries in the Q&A section. We'll be monitoring them throughout the webinar, and if it's appropriate at that time to answer them in the presentation, we'll do so. Some we may have to wait till the end, but we'll make sure we get through them all for you. Little brief thing about McQueen Financial Advisors. We are a premier financial advisory firm here in the United States. We do three core lines of business. One is in the portfolio management world, which is one of the things we're going to talk about today with 201 Investments. That's managing your institution's core portfolio or standard portfolio. We also have employee benefit accounts that we advise on and manage, and charitable donation accounts. We also have a vertical in the investment world through that manages foundations and nonprofits and Taft-Hartleys, and then also a wealth management division as well that runs through our Integrity Investment Management. All that can be found on our website. The next vertical we have is asset liability management. We do interest rate risk management through there, the analysis, the reporting, the advising, and ancillary reports like core deposit studies, prepayment speeds, liquidity stress, CECL, as well as concentration risk, along with some others. And then lastly, we have our third vertical is the mergers and valuations group. Great group, growing. We do a lot of valuations for actual mergers, credit union to credit union buying banks. We do transaction advisory, fair market valuations, as well as mortgage servicing rights. So that's a little brief. I won't get too long-winded on McQueen Financial, but what I want to do is now, as we go through the presentation, remind you, please ask questions. And then what I want to do is just make a brief introduction and we'll get things rolling. I'm Craig Cecilia. I'm the Chief Investment Officer here at McQueen Financial. We have two advisors with us. One, Alicia Bradley, a senior advisor here who has been with us for over a decade. She works with credit unions and banks across the country doing interest rate risk management, advising, consulting to team, senior management, as well as boards, and runs a lot of investment portfolios for us. Thank you for joining us, Alicia. Yeah, you betcha. Then next is Zach Brown. He's a superstar also here at McQueen Financial. He does interest rate risk management consulting with both Jacor team, works with boards and training, as well as C-level management and training. And he also runs a lot of investment portfolios for our institutions across the country as well. Zach, thank you for bringing your knowledge and joining us today as well.
Yeah, thank you for having me.
Yeah, you're welcome. So now that all the great introductions are done, I think with further ado, I'll hand it off to Alicia to get the presentation started. And one last reminder, ask questions as we go along.
And I am actually going to let Mr. Brown kick us off today. So Mr. Brown, you want to give us a quick overview of what we're going to cover today?
Yeah, thank you. So I got an overview here. We're going to start the presentation off by getting into portfolio diversification, which is really key right now. Then we're going to do a deeper dive into asset classes. We touched on a little bit in 101. We're going to do a deeper dive this time around. And then we're going to touch on portfolio duration, the fun stuff, and then key takeaways at the end. So we're going to start off with diversification. And Alicia, what are some benefits there?
We want to, well, why do we diversify our portfolios? We have several little bullet points up here. The first and the biggest is to avoid a concentration. There's the old saying, you don't put all your eggs in one basket. The same thing goes for your investment portfolio. You want to make sure that you have your asset classes diversified within your investment portfolio for the following reasons. There are shifts within relative value and or yield within any given asset class. We'll get into some of the yield spreads in one particular asset class, and you'll see that at one point, CDs had a great deal of value, and at another point along the curve, they did not have a great deal of value. We want to work to manage our risk. So we don't want a portfolio that is all full of one specific type of asset class because that asset class carries the same type of risk. Specifically, if we were to look at MBS and we are a lending institution on the retail side, then we have a doubly concentrated portfolio because the loan portfolio and the investment portfolio carry the same type of risk. And we want to work to manage our maturity ladder in the average life of our portfolio. Different asset classes have different weighted average lives. Some have static maturities, while some have amortizing maturities. And we get a combination of the two. It just gives us a better, well-rounded investment portfolio overall. So then how do we manage our investment portfolio from a diversification standpoint? First, we look at asset classes. Again, I mentioned, MBS on the last slide. We want to make sure that we're looking at various different asset classes within the investment portfolio. We want to look at different terms as well. We want to make sure that we're diversifying in the maturities that we're actually putting into the portfolio to build out our maturity ladder appropriately. And then the last one is time. We want to make sure that we're putting cash to work on a mostly consistent basis. I know COVID has definitely thrown us a curveball on that time piece over the last couple of years where we did a lot of investing in 2020, 2021, and then we didn't do a lot of investing through 2022 and 2023. But we want to make sure that we spread those investments across various time frames to take advantage of the different relative yields that come along the curve in the different asset classes. Mr. Cecilia has a question.
I do. And it was just a comment there, Alicia, on that timing thing. You really illustrated it well in that 2021
Thank you.
timeframe. It's hit a lot of institutions along the country, right? Kind of
Mhm.
think about some bank failures in 2023, right?
Yeah,
What they
just a
had in
couple.
underwater unrealized losses. And, a lot of us on this call and some prospective clients probably have investments that take place throughout the year on a rolling, ongoing basis. So they have a lot of liquidity that continuously comes in. And others might say, hey, we only invest a couple times a year.
Right.
And it really matters for the ones that only invest a couple times a year. Like, hey,
Yeah.
spring we come flush with money, 50% of it rolls out, and then we slowly grow our assets and eat one once a year type thing.
Yeah.
That's where that time thing really does make sense. Because if you're doing that one time a year purchase all at once, you're basically making a bet on interest rates or where they're at instead of spacing that out a
Absolutely.
little bit. So
Yeah. So
I
that
like,
time piece is super important.
yeah. Well,
Yeah.
so well said.
Thank you.
You're welcome.
So then from here, we're going to dig into several of the asset classes that we look at for the investment portfolio. Please know that this is not an all-encompassing overview. We're going to cover the largest ones that we look at. There are some more detailed, more specific or complex ones that we're not going to cover in here. But I'm going to let Mr. Brown kick us off with treasury bonds.
Yeah, so treasuries, they are the chicken tenders of the investment world. Very vanilla. Everyone is familiar with treasury. It's debt issued by the U.S. Treasury. Repayment is guaranteed by the government. So they're about as safe as they come. They have a fixed term, fixed coupon, and a final stated maturity. So there's no optionality with treasuries, which is really good right now. They are the risk-free benchmark that we use. So when we're looking at investments, say we have a 3-year muni, we will compare that 3-year muni municipal bond to the 3-year treasury to determine the value there, the spread over that risk-free rate. And since they are guaranteed they're by the government, they carry a 0% risk weighting. So they don't impact your capital in that regard. The treasury is nice introduction, nice asset class to start out with. There's some other stuff that you should look at as well, though. Alicia, what are some pros and cons of treasuries?
All right. On our pros, they are the most liquid of all asset classes. I do want to note in there they do devalue, maybe not as similar or maybe not in the same fashion as other asset classes, but they do have the potential to devalue. They also have the potential to increase in value depending on what the market does. They are pledgeable for all of your pledgeable needs. We can buy them in a large block size. So whether we're looking to fill an investment request that's $100,000 or whether we're looking to fill one investment for $10 million, we can buy treasuries in any block size. We have the ability to fill in the ladder across all maturity buckets. We know some of our clients have very specific maturity ladders that we're looking to fill based on what their cash flow needs are. Craig mentioned timing of investments. Some clients need more cash flow in very specific months based on the cyclicality of their members' deposits. With treasuries, you have the ability to do that. You often have the ability to do it as well within 2 different maturity dates within any given month. As Mr. Brown mentioned, they are 0% risk weighted. And the only con there is that there's no spread because they are our benchmark. We add the spread to all of our other asset classes based on the treasury when we're looking to compare asset class A to asset class B to the treasury curve. So they are, because they're the benchmark, 0% risk weighted, they don't carry any spread to them in most scenarios because asterisk, sometimes they are the more advantageous asset class. So from there, we're going to look at certificates of deposit. Mr. Brown?
Yeah, CDs. Everyone is familiar with CDs right now. They've been very popular over the past few years because of their yields and their risk profile. So they are issued by financial institutions. They have a fixed term and coupon rate like a treasury. They are insured by the FDIC up to 250,000. So once you go beyond that amount, there's some added credit risk there. But when you're below that threshold, that credit risk is eliminated. Despite that, they carry 20% risk weighting, and the rates on these are really market driven. So a few years ago, the CDs were one of the worst investments you could buy. They were consistently below the treasury, 10, 15, 30 basis points, below the treasury. Now a lot of that value has reemerged because people need liquidity. Liquidity is a little tight. So it really depends on liquidity in the market. They're almost unbeatable in times where liquidity is tight, like right now. But when liquidity picks back up, you're going to lose a lot of that value there. You can see in a few slides, we'll see the value there. It's starting to shift down with liquidity picking up a little bit compared to last year and the year prior. Alicia, what are some? I saw a couple of different CD types that we have. What are we looking at there?
I was going to say, I'll shift to the slide spread now if you want to talk about that, and then I can go back to the different types.
Oh yeah, for sure. Yeah, so you can see CD rates. So what we're looking at right now is that gray line. That's 2024, and I think that's brown, 2023, and blue line, 2022. So you can see significant shift down in value compared to the prior years because liquidity has picked back up a little bit. There's still a lot of value in that 1 to 3 year space. That seems to be the sweet spot. But once you go beyond that, that value starts to drop a little bit. And the reason being is because no one wants to issue long-term funding. As an institution, you wouldn't want to go out and do 5-year CDs right now at a high rate. So they're trying to avoid locking in long-term funding. So sticking to that shorter term stuff. So more options there. And that's where where we see that value in that 1 to 3 year space seems to be the sweet spot for CDs right now.
Most definitely.
Yep.
All right, so then I will flip it back to the different types of certificates of deposits. So there's two main different types. We have brokered and then we have direct purchase. So your brokered CDs tend to be more liquid. They are traditionally a CUSIP holding. They can be sold on the secondary market. So that if we need to liquidate items within a portfolio, whether it be from a liquidity standpoint, or if we're looking at a swap in order to swap out of a lower yielding item to move into a higher one, they can be easily sold. They can be purchased through most brokerage firms. So let's say you see an item from brokerage firm A, however, you don't have a relationship with them, you can call brokerage firm B, you can give them the CUSIP. They can generally go out and pick that up on the marketplace. And they do have it a marketable value. It is determined by market conditions. So part of it is the coupon rate on the actual certificate of deposit itself. The other part of it is the name. Some of the larger names, while incredibly liquid, they're held in a lot of different portfolios. The other type of CD is what's called a direct purchase, and they are less liquid because they cannot be sold on the secondary market because they're generally non-CUSIPed. So since they can't be sold, they typically have a breakage penalty. The issuer does have the right to refuse that penalty, and that penalty is typically somewhere 3, 6, I've seen them as high as 12 months of interest. And they can only be purchased through a specific relationship. So these are the Simplicity CDs and the Quick Rate CDs of the world. So there's just a little bit of a difference between the two. So knowing what you have in your portfolio is very important. And then we have our pros and cons here on our CDs. So the pros is that they're guaranteed as long as we purchase them under the FDIC or the NCUA insurance limit. When we make those purchases, we tend to purchase less than the $250,000 insured amount so that we can make sure if an institution were to go bad, not only do you get your principal back, but that you also receive that last coupon payment that you're due. And high yields tend to appear when liquidity is low. That can be a pro or a con, depending on how we want to look at it. And then the cons are the small purchase sizes. Unlike treasury bonds where we can purchase up to 10, 15, 20 million in a piece size, we're limited from an insurance perspective to up to $250,000. We can buy them in larger block sizes, but we lose that insurance guarantee. They have a limited maturity range. So if we're looking at CDs today, we're in the end of May. The majority of what we're going to see right now is going to have a November or May future maturity date. They tend to be in that 6 or 12-month range. And then from there on an annual basis. So we'll see a lot of May maturities coming due right now. They are not pledgeable. And then the con, CDs have a low yield when we tend to have liquidity. Just because we're not necessarily looking to bring deposits in, we're going to decrease our deposit rates as an institution. The remainder of the market does that as well. And then from there, we will switch over to our next asset class, which is U.S. agency bonds.
Yeah, so agencies are debt issued by government-sponsored enterprises. So Fannie, Freddie, FHLB, those are the most common you'll see. There's some few others as well, but those are the main issuers. They carry an implicit guarantee. So what does that mean? If the entities fail, the government is not obligated to make good on that debt. It's an implied guarantee that they would. Because of that, because it's not an explicit guarantee like treasuries, they have a little more risk and they carry 20% risk weighting like the CDs do. So with agencies, though, you got to be careful because there's different types of structures. Very important to look at that. So bullet agencies are the good ones, fixed rate and a stated maturity date. And then you have callable. You got to be careful on the callables. So callables essentially means the issuer can call the bonds back anytime before maturity, depending on the structure. And within the callable, really important to look at the lockout period. So the amount of time before the bonds can be callable, that's your protection there. And then the call frequency. So after that call lockout period ends, how frequent can the bonds be called back? So the optionality will vary from one-time call to anytime callable. So you got to be really careful. In general, we're not a big fan of optionality in this environment, specifically on the callable agencies. There's a big risk that if rates fall, even a smidge, the issuer is going to call those bonds back if it's financially beneficial for them. So if rates fall, and then you get your proceeds back. Now you have to reinvest into lower rates, and that's not ideal. So you want to go out and lock in the longer term rate at the higher at whatever the prevailing market rate. I know callable agencies, there's attractive yields there, but there's a reason for that higher yield premium. So we recommend sticking with bullets at this point in time. So just to be careful, keep that in mind when you're looking at investments. So in regards to agencies, what are we looking at value-wise?
Before I get there, I just want to piggyback on Zach's comment about the optionality because it's something we have, as a team, have been talking a lot about. And sometimes we'll say to our comment that we don't want to look at this bond because it's negatively convex. So for context, what that means is exactly what Zach talked about, is how the bond may show a great coupon or a great yield right now. However, if and when that bond gets called, we then have to reinvest those proceeds into a lower yielding security. That shift in yield when a bond gets called and we have to reinvest lower is the negative convexity, because we're losing funds as we move forward with that investment. And as of right now, as Zach mentioned, we are staying away from a lot of those negatively convex bonds. So then when we look at our yield here, the blue line is the US Treasury curve. The green line is the agency curve. You can see that there's some spread there on the short end, 3-month and 6-month. It tightens as we get to the 2-year, through the 5-year, and then it starts to widen back out. Generally, agencies only hold somewhere between, I guess it's kind of dependent since I've been here for over a decade. Sometimes it's been 20 basis points, sometimes it's been negative to the Treasury curve. But generally, they should hold 5 to 10 basis points above the Treasury curve. You want to make sure that you are picking up that additional yield against your Treasury curve in order to make sure that that bond is yielding appropriately for the portfolio. And then from there, we're going to flip it over to our pros and cons. Agency bonds are incredibly liquid, just about as liquid as Treasury bonds are. They are also pledgeable, so you can pledge them to the FHLB or against any line of credit. They also come in large block sizes. They're a little more restrictive in terms of block size because sometimes an issuance is only issued for $10 million. So if we needed to buy more, we would be restricted in that sense. We do have the ability to go back to the issuer if it were FHLB or Fannie Mae and say, hey, are you willing to upsize? It can happen, but there's a small limitation there. They're great for filling in the ladder because we can find agency bonds, whether they are callable or bullet maturity in almost any month and or year. They generally hold a spread to treasury notes. And then the biggest con is to be aware of that optionality, to make sure you know what those bonds look like. I had a client email me today with a broker offering, and the title was 6% exclamation point, great option. And when I looked at it, it only gave the first call date. It didn't give any of the potential future optionality. So we don't know how often that bond was then callable after that first call date. So just definitely be aware of that while we are moving forward. Craig, you got a question?
Yeah, just a quick one there. Yeah, and you addressed it really well there with respect to that optionality and the warning of that one bond example is, and we all got to make sure that we think about our balance sheets when managing this investment portfolio. That optionality, the negative convexity that we are allowing the issuer to have, the ownership of that, we do not get it. It really is not a great idea to have much or any, depending on your balance sheet, of these callable type of bonds, because you have no control over it. And it really has to really fit within your asset liability management, interest rate risk modeling process. So they're out there. Be careful. Not saying don't do it, but I'm saying don't do it, if you will.
If any of us lived through COVID, which all of us here on this call have, we all remember what happened when rates fell and a significant amount of cash rolled out of those investment portfolios, yielding a nice 2, 3, 4% and was all reinvested at 25 basis points. So that's a perfect example of that negative convexity right there.
Yeah, sometimes that extra yield causes people to drink the Kool-Aid, and so
It does. It definitely does.
All right, thank you.
All right, so then our next asset class we're going to look at is municipal bonds. We have a lot here for you on municipal bonds because they're definitely not quite as vanilla as the last couple asset classes that we looked at. So Mr. Brown, I will let you walk us through GO and revenue municipal bonds.
Yeah, a little more complexity with these guys. They are debt issued by municipalities. Example would be the city of Clawson, Michigan. They're going to go out and issue a municipal bond to pay for sidewalk repair. With munis, very important to look at the repayment source on the bonds. And that's where it splits between the GOs and the revenues. GOs, general obligation, the repayment is paid back by the issuer's taxing authority. So if the issuer needs more money to repay, they can go ahead and simply raise property taxes, which seems pretty nice. I wish I could do that to pay my stuff, but within that, there's limited tax. So the amount that they can raise is limited. And then the unlimited, the repayment is not subject to a voter approved limit. With the GOs, there's a 20% risk weighting. And then with the revenues, the difference there is it's paid, the bonds are paid back by a specific revenue stream. So we got a few examples there. I always like to give an example of like a parking garage. They're constructing a parking garage. They're doing a bond to finance it. And then the repayment from that bond is going to come from tickets. So there's more risk with revenue bonds because if you think of it, the success of the repayment is dependent on the success of that project. So a little more things you got to think about with revenue. Very important to look at both of their credit, which we'll get into in a second too. But with revenues, since there's a little more risk there, a higher risk component, there's a 50% risk weighting on revenue bonds. So from there, a big distinguishment on these guys is that they have specific tax treatment, right? So that's what really separates these from the other asset classes. And Alicia is gonna touch more on that.
Yep, so this is where we start to get a little more granular because not only are there 2 types from a repayment standpoint, but there are then 3 types from a tax status standpoint. So 3 different types of tax statuses when it comes to municipal bonds. We have taxable, we have general market tax exempt, and then we have bank qualified tax exempt. Taxable bonds, just like their name implies, the interest income that's paid from them is subject to taxation. So the yields are generally higher to compensate for the fact that you have to pay taxes on that income. They are a great option for our credit unions because credit unions can take advantage of that higher yield without having the tax burden. And banks can also benefit from those higher yields depending on what their tax status looks like. Are they making money? Are they not making money? Do they have a deferred tax asset that they're looking to offset? So that is one type of municipal tax status bond. The second type there on the page is a general market tax exempt. This is the largest sector of municipal bonds that comes to market. The interest income is exempt from taxation, thus the name tax exempt, and the yields are traditionally very low. When I say very low, they used to be 5 basis points, around 5 basis points around the Treasury, maybe a few basis points below. Right now, they're significantly below that Treasury curve right now. These are typically issued or typically purchased by high net worth individuals or insurance fund. Banks and credit unions generally avoid these given the yield differential on them right now. And like I already stated, they make up the largest portion of the municipal market. And then that third kind on there is bank qualified tax exempt, or what we call BQ munis, where this interest income is also exempt from taxation, state dependent. These issuers fall into a little bit more of a niche. The issuers themselves are limited to $10 million annually of bank qualified debt. There are some loopholes to that, but generally given that $10 million block size limitation, the maturities tend to be a little bit on the smaller side. And then the tax advantage here is when banks purchase them, that's why they're called bank qualified, because they're then taxed up by the current tax rate to get to what we call a taxable equivalent yield. And then that's the yield we then compare to the Treasury curve. And then we're going to get a little bit into credit here on municipal bonds.
Yeah. So credit risk, very, like I said, very important to understand the credit risk of each issuer. Unlike treasuries and other securities, there's a really big risk if you could potentially lose your principal if the municipality can't pay, right? So you got to really do your due diligence on the bond and the issuer, both before buying it and really on an ongoing basis. And for the time that you hold that bond, you should always be looking at that credit whenever they release their financials. Very important to do due diligence on the credit. But with that added risk, generally you get more yield, right? Just like anything, more risk, more reward. So the more risk you take, you should expect to receive more yield. So with municipal bonds, there's great value there. It's crucial. You just got to do your homework and understand the credit, and continue to be on top of the credit for the remainder of your the holding with that asset class in particular. So Alicia, you got the pros and cons next. Let you touch on that one.
Yep. All right. So the pros are our spread. Mr. Brown's going to cover that on the next slide. We've got a graph for you. But there's generally a decent amount of spread there in the municipal bond space. The ability to support your local area. So all of us as community financial institutions want to make sure that our members and our clients are being supported. So we have the ability to purchase into projects that affect our client or our membership base. We also have the ability on the opposite side to diversify our geographic holdings because the majority of the loans on our balance sheet are going to be local to our institution. So that means that in some way, shape, or form, the risk that those loans carry is all going to be subject to the same economic type of risk. And if we can diversify our holdings a little bit, we can see a little bit of additional value there. Now on the con side, Mr. Brown mentioned on the prior slide, the credit risk. There is some credit risk with these municipalities. They are not government backed, especially those revenue bonds. They do have a slightly higher risk weighting. We do all of the credit work for those on a quarterly basis though. We do pre-purchase due diligence and then consistently ongoing due diligence. They are not pledgeable. There should be a little asterisk there. There are some municipal bonds that are pledgeable. However, they are few and far between. The best way to find out if it's pledgeable is to send the QSIP to FHLB if that's where you're going to pledge it. They will do some legwork and let you know. It is not a quick 15-minute or 1-hour process. It typically takes a couple of days. The piece size we're allowed to purchase is subject to the size of the deal. So I talked a little bit about the bank qualified piece size. Some of the taxable deals, I've seen them as small as 4 or 5 million. I've seen them as large as 300 or 400 million. The size of the deal determines the size of the individual maturity. We don't get to pick our maturity month. The issuer decides the month that those are going to be due. So example for here in Michigan, the majority of the municipal bonds issued by any of the municipalities in the state of Michigan are going to have a May or November maturity. And then we're not always allocated on bonds. If the market has a significant amount of liquidity that it's looking to get put to work, a deal is what we call oversubscribed, meaning that they have more orders than they have bonds available. So sometimes we are cut back on our orders, and other times we do not get allocated any bonds at all. All right, Zach, you want to talk us through the spread on taxable municipal bonds?
Yeah, great value across the curve, as you can see, with municipal bonds. The further you go out, that better that spread is and the wider it is from the treasury. And that's because the risk, right? You're taking on more risk for going out further. You buy a 5-year municipal bond, you're making a bet that that municipality can pay you interest for that 5-year term, and then they can repay you at the end. So there is risk there. We love taxable munis for a lot of our portfolios because we have the due diligence side of it and we understand the risks. But before purchasing it in general, you just want to understand you want to make sure you understand the credit and target a term that fits your balance sheet and your risk tolerance as well. So
Well
with
said.
that, yep, go ahead.
As I say, well said.
Okay, gotcha. Yeah, with that, we got corporate bonds.
All right, so corporate bonds. Corporate bonds are simply debt issued by U.S. corporations. They're similar to muni bonds in the fact that they are subject to credit risk. They are a credit-related product. They do tend to offer a higher yield as well compared to treasury and agency options. Now, the value within that space toggles back and forth between corporate bonds and taxable municipal bonds. I'm going to skip over the middle bullet point, go to the bottom one. They are 100% risk weighted because they're not backed by any sort of. The only thing that backs them is the revenue producing capability of the company that's issuing the debt. So they are 100% risk weighted from that standpoint. For federal credit unions, corporate bonds are a non-allowable asset class. So in that instance, we then tend to look to banknotes for that exposure because sometimes we do need that yield pickup, and there are some very strong corporate and/or banknote names out there. The difference between a banknote and a corporate is that the banknote obligation is issued at the bank level versus the holding company level that the corporate bond is typically issued at. Mr. Brown, you want to talk a little bit of spread on corporate bonds?
Yeah, for sure. Looks very similar to the municipal bond one. A lot of value with corporates and banknotes. The further you go out, the more you are compensated and due to more risk. As with munis, though, same thing goes with this. You just got to make sure you understand and are comfortable with that credit, and you want to pay attention to your policy limits and identifying how that bond is going to fit in your balance sheet holistically with everything considered, your interest rate risk and everything. So very, very important to understand the credit and how it fits within the balance sheet overall, but a lot of value with corporates. So next, I am going to touch on some pros and cons of corporates in the next one there. So the first set of pros and cons, they go together, spread and credit risk, right? There's more risk, but you're also compensated. There's higher spread there with these types of bonds. You can mitigate that by focusing on different credit tiers. Moody's and S&P, they'll have the ratings there. And you can target whatever rating you want, and you can go to the higher end of that spectrum to eliminate some of that credit risk and mitigate that. Large piece sizes can be found, so they're pretty flexible in the amount you can purchase on like a CD. You're not limited to 250,000 there. You can purchase as much as you want as long as it fits within your policy. On the con side, they're not pledgeable. I don't believe any corporate bonds are pledgeable, and some have a degree of optionality, right? Which we want to avoid. In addition to a standard call, a lot of them will come with what's called a make-whole call. So this is kind of interesting. Essentially, what a make-whole call it means is that the issuer can call the bonds back at any time after settlement, right? You can buy a bond, it can settle today, and it can be called today. So it's a little different in structure from a standard call, and they're not as often exercised as standard calls. It's not interest rate driven typically. But the key with make-whole calls is to understand what that make-whole call is, that price is. You want to look in the prospectus and dig into that and identify what that price is. Oftentimes it'll be the greater of par or a spread plus a treasury. So in general, you can eliminate a lot of that risk by buying the bond at a discount, because oftentimes every make-whole call I've seen has a minimum of par. So with that, you got to keep that in mind with make-whole calls as well.
Yep.
Now we are going to dive into the fun ones, mortgages. I'll hand that over to you.
These are our very non-vanilla asset classes here. All right, so MBS and CMOs, or amortizing bonds. MBS stands for mortgage-backed security, and CMO stands for collateralized mortgage obligation. They're both very similar, yet very different. They're both residential mortgage loans that have been securitized into a bond that has a coupon as well as a maturity date. MBS is the more vanilla of the two. It has a very generic pass-through structure where the principal and interest payments are simply passed through to the investor. In a CMO, there is a waterfall structure where that cash flow is prioritized depending on the structure of the security. So there are multiple what we call tranches within the CMO, and each of those different tranches has a different cash flow and weighted average life expectation. MBS and CMO generally as a whole are 20% risk weighted when issued by Fannie Mae or Freddie Mac. If we're looking at Ginnie Mae bonds, those are 0% risk weighted. It also tends to be a different loan profile or socioeconomic profile within the loans that are in a Ginnie Mae bond. Mr. Brown, we have a list of things to consider here. You want to talk us through each of these as we
Yes.
continue to go through MBS?
Yep. So you got to look at a few things, several things when looking at MBS and CMO. First one, kind of very similar, prepayment extension risk. Mortgage investments are going to be very interest rate sensitive. Just like with standard mortgages, if rates fall, people are going to want to refinance their loan, which is going to set up prepayment risk. If rates rise, people like we've experienced, we're the environment we're in now, right? People are going to hold on to their mortgages, which sets up a lot of extension risk. So those two in particular, you really have to also pay attention to the price you pay for this type of investment, because you can really get burnt if you pay a premium or a discount, depending on which way you go there. Internal loan portfolio. So you want to strike a balance between your investment and your loan portfolio, right? I touched on this a little bit on the last webinar, but mortgage loans and investments are going to behave the same way when rates move. So you're setting up a lot of risk if you are overly concentrated in this area. If you have a ton of mortgages on your loan and your investment side, and rates fall, you're going to get all that cash flow back, which is not ideal. Geographics. So loans in certain states are more sensitive to interest rate movements, right? So with this, you just want to pay attention to that mortgage-backed security or CMO and the specific states within that, and make sure you're not overly concentrated in one or two states. We like a nice balance there. Loan count. So you really want to pay attention to loan count. If your bond has a lower loan count, each loan will have a bigger influence on the performance. So more loans in general, we like will be less volatility. We typically like closer to 1,000 loans within the specific security. I mean, give or take, it can be a little less if there's some mitigating factors, but in general, we like around 1,000 loans there and above. And then coupon stack, how it relates to the market rate of the loan. So you just want to compare that coupon to the market rate to estimate the bond's performance. If the coupon is a little lower than market rate, you're going to have a little more prepayment protection, because if rates fall, you have that buffer there. Those mortgages are still out of the money, and people are not going to want to refi. So very important to look at all of those factors when looking at mortgages. So next up, we got some pros and cons. Over to you, Alicia.
All right. So on our pros side, we have spread. The one thing we don't have for you with MBS and CMOs is a spread chart, because you're going to get a different level of spread based not only on the type of mortgages that back it, but the coupon of that pool, as well as how seasoned it is and what that weighted average life is. So we don't have any sort of spread graph for you, but generally there is spread on amortizing product. They are all pledgeable, whether we are looking at Fannie Mae, Freddie Mac, or Ginnie Mae, they are all pledgeable. We can buy large piece sizes. A lot of these mortgage pools tend to be issued in the whole pool itself is generally $100 to $200 million. Sometimes they're a lot larger. We've definitely seen some smaller ones, but they're generally very large, so piece sizes are available. We get an amortizing cash flow from these. So all of the other securities that we've talked about to date have a static maturity, i.e. your bond is due March 31st, 2025. Your MBS or CMO bond may have a final maturity of March 31st, 2045. So it's 20 years away or 21 years away. However, you're going to get cash flow back on a monthly basis, not only on the principal side, because we all make a mortgage payment every month, but there's going to be the coupon payment on that bond as well. So these bonds have what we call a weighted average life, because they are going to amortize down versus receiving all of our funds back in one lump sum. And then concentration risk. It's a nice way to diversify our balance sheet from what we hold in there. If we do not have the ability to put mortgages on our balance sheet on the loan side, we can put them on in the investment portfolio by selecting bonds that have a shorter weighted average life. And on the con side, the first two actually go together. We have extension risk and prepayment risk. So in the environment that we're in right now, a couple years ago, the majority of us refinanced mortgages or bought houses and have an interest rate of 3 or 4%. Mortgage rates are now 8%, or 7.5, 6.99, depending on where you're at. So those bonds all have extension risk on them because we do not have any incentive to prepay those mortgages. On the opposite side, there is prepayment risk. During COVID, when we all went out and refinanced those loans or bought houses in that 3 or 4% range, we got rid of those 5, 6, 7, 8% mortgages, and those mortgages all paid down quickly. That's what that prepayment risk is. We had an increase in those CPR speeds and the bonds paid down faster than anticipated. We do have some premium risk. So just like the majority of the other asset classes we talked about, with the exception of CDs, the majority of the bonds purchased in the market are issued either at a premium or a discount, dependent on what the coupon of that bond is and what the current market rate environment is. With the amortizing bonds, there's a premium that has to be amortized down. We generally amortize it to roughly the weighted average life. If there is a significant increase in prepayments, we also then have a significant increase in our premium amortization, which has the potential to give us a negative yield. Also on the con side, we'll see amortizing cash flow. If we're trying to fill a specific bucket, amortizing cash flow isn't the way to go. We want to make sure we're then looking for a static maturity. We've touched on concentration risk, and then we have what we call tails. So if we were to buy $1 million of a mortgage, as that mortgage amortizes down, that $1 million becomes smaller and smaller every month. Eventually, we're left with a small piece of it. A lot of times we can do what we call a tail cleanup, and we can work to clean those up. Sometimes, though, if we let them get too small, they can be a little tricky to get rid of. Nope, I'm going to take this one. I'm going to kick us off with CMBS. I actually like CMBS. There's a lot to talk about here, but I'll keep it very high level. CMBS is very similar to an MBS. It is a commercial mortgage loan they're securitized into a bond, again, with a coupon and a maturity date. The three most common types of CMBS are listed here. There are several others. There is a Fannie Mae DUS bond, a Freddie K bond, and a FRESB bond. A Fannie Mae DUS bond we like to call them bullet alternatives. They tend to be a little bit on the shorter side. They have a final stated maturity, sometimes 5, 7, or 10 years. They typically have an interest-only period, which makes them that bullet alternative. Once the interest-only period is done on that bond, then it will start to amortize in cash flow. That interest-only period, if it's a 10-year bond, it may be 7 years or it may be 9 years, and that's when you start to receive those larger lump sum payments back. They are typically a fixed coupon. There are variable rate ones out there. I touched a little bit on the structures. It can be a 5, 7, or a 10-year, and they're typically backed by one loan. They don't have a large pool of loans. There are structures out there where there are multiple DUS bonds that are collateralized into a larger pool, but a DUS is typically one loan. A Freddie K structure is structured like a CMO. It can have a fixed or floating coupon, and it is backed by multiple loans. So on the Freddie K side, when the Freddie K issuance comes, you have your Freddie K, we'll call it Freddie K 1, 2, 3. And within that 1, 2, 3 pool, there's going to be an A tranche, a B tranche, so on and so forth. And each of those different tranches will have a different cash flow structure It will have a different maturity, and it will perform differently. Each one will perform slightly differently than the next. And then we have what are FRESBs. And this is a Freddie Mac product. They are backed by multiple smaller business balance loans. Unless that loan amount is changed, I think the maximum loan size is $6 million. The loans that go into your Freddie K generally tend to be much larger than that $6 million. It can be a fixed floating or hybrid coupon, and it is also structured like a CMO, just like the Freddie Ks. CMBS carry a 20% risk weighting because they are issued by Fannie or Freddie. There are some Ginnie Mae CMBS as well. Those do carry a 0%. We don't see them as often. And a lot of times a CMBS pool can be eligible for CRA credit. So if that DUS bond or if there is a pool of loans within the K or the FRESB that fall within your local footprint, specifically in a low income tract, it does have the potential to be eligible for that CRA credit. And Freddie Mac will oftentimes issue a letter letting you know that this pool does fall in a low income tract and has the potential to be eligible for that CRA credit as well. Zach, you want to walk us through the pros and cons to CMBS bonds?
Yeah, sure. Pros, starting off the pros, they're generally longer, which gives them higher spread. So there's more spread with these asset classes. Pledgeable, which is nice. You can use them as collateral. You can also buy these in larger piece sizes. You're not limited there. The amortizing cash flow on certain structures, which can be nice in certain environments. And they are a great asset class to diversify and limit concentration risk. You do a lot of mortgage-backed securities or municipal bonds. You can throw this into the mix to limit that as well. On the con side, so some of these are going to have a degree of extension and prepayment risk, right? If rates fluctuate due to the amortizing cash flow. With that premium risk, right? If you pay a premium for the bond and it prepays, you could get burnt there, depending on how you're amortizing it. Amortizing cash flow, less predictability here. This is also going to tie to the prepayment penalty. The borrower could potentially wait until that window they're out of that window, prepayment window, and pay the loan off, which is just more uncertainty overall, which is not good. And then concentration risk. Many of these CMBS are longer term, right? So if you overload in certain types and none of them prepay, you're stuck with longer term investments at that point in time, which is not ideal if that's not what you're looking for. So these, we gave you a quick rundown of all the asset classes. Like Alicia said, there's a ton out there. This is just a high level overview of the ones we focus on. But now with that, we're actually going to go right into duration, the fun topic. And Alicia, I'll let you do that one. I'll let you start that off.
I will kick it off. Duration isn't something we talk about as much as we talk about weighted average life or the diversification or how does it fit into our ladder. So let's start us off with what is duration. By definition, duration is the measurement of sensitivity to a change in interest rates. It is not weighted average life. It's expressed in the same sort of term as weighted average life, but it is not. So the things that duration take into account are the maturity of the bond that we're looking at, the yield of that bond, its coupon, and its call features. So Zach, why is duration important?
Yeah, why is it important? It all comes down to interest rate risk management at the end of the day. Bonds that are typically longer will have higher duration, right? More interest rate sensitivity. If you have high duration, interest rate fluctuations can really hurt you on your balance sheet risk, right? Just like looking at longer term loans, looking at mortgages, we want to just pay attention to longer term investments with high duration and sensitivity, and maybe diversify away from with some shorter term ones to offset that risk. But at the end of the day, it just all boils down to interest rate risk management and managing your balance sheet. So with that in mind, how do we choose the right duration?
All right, so when we're looking at a bond and we're looking at that duration, we want to look at what does our balance sheet look like? What is our loan structure? Are we looking at mortgages? And if we are looking at mortgages, do we have mortgages in our loan portfolio? Are they short? Are they long? Are they geographically concentrated? Do we have a specific rate that we need to stay away from because we already have a lot of it in our loan portfolio? So we want to look at that structure. We want to look at our portfolio structure. We also want to look at our liability structure. We want to make sure that we're aware of, do we have a lot of short-term liabilities or a lot of long-term liabilities? Craig mentioned early on in the call, we had a bank failure last year. That bank had all very long investments or in very long mortgages, both in their investment portfolio as well as in their loan portfolio, and then a super short liability structure. We've got to have a good balance of both. And then how do we maintain it? So we look at our maturity ladder within our investment portfolio. We look at the price sensitivity of the bonds that we're actually looking to purchase, and how does that price sensitivity fluctuate in an up or down environment? And then we look at convexity. I mentioned negative convexity earlier in the presentation. We're not going to touch too much on it, but we want to look at that and what sort of convexity is in our portfolio. And the one thing we can do is we can run different simulations to look at how does the duration of specific investments, if we were to start pooling them into the portfolio, look compared to our current balance sheet. Mr. Brown, when we're looking at our maturity ladder, what do we want to look at?
Yeah, so best way to manage duration is diversifying, just like anything else, right? You want to diversify your ladder. So you can do this through looking at asset classes. Certain investments are going to have more sensitivity, more duration. You can reduce that by diversifying into shorter term or other asset classes with less duration. Final maturity. So this one is where you look at that term, right? You add a mix of shorter term bonds to offset the longer term bonds that are more sensitive and have a higher duration. And then just limiting optionality, that's key. So bonds with a lot of optionality, mortgage-backed securities, callable agencies, they're generally going to be a little more sensitive and have higher duration. So you want to diversify with bonds with no optionality. Preferably just do bonds with no optionality regardless right now. But that's a good way to manage that.
Yeah.
So now it looks like we got an example of how duration affects the bond's market value.
We do. So it's exactly what it is. So if we buy bond, we're going to use $1 million as an example. On the left-hand side there, we have a 1% rise in rates. So if rates go up 1%, over the course of 1 year, we can see that we have a minus 1% change. So the market value on our bond becomes $990,000. If the duration of the bond is 10 years and rates go up 1%, we have the potential for a negative 10% change. Now, keep in mind, these are just examples. That market value then becomes $900,000. So the longer the bond, we can see the larger the change and the larger the decrease in market value on that bond. So the larger loss we would potentially carry as an unrealized loss on our balance sheet and or have to incur if we needed to sell that investment for liquidity. If we see a 1% drop in rates, meaning that the bond that we hold has a higher rate than what the market is seeing, we see a positive change in duration. So for 1 year, we would see a potential 1% change, which increases our market value to $1,010,000. And then looking at that 10-year, we can see that we have a 10% positive rate change. So then that market value increases by $100,000 or 10% because the bond that we hold is 1% higher than what the current market rate is on that same bond with a similar maturity. And then how does that duration change as interest rates change? So we've talked quite a bit, I feel, about today about negative convexity. The duration on a bond increases as rates increase. So what negative convexity is. So negatively convex bonds are such things as MBS, because as those bonds, as rates go up, we see that extension, and as rates come down, all of those loans prepay. So we're losing that high yield that we have, and we have to reinvest into a lower yield. Same thing with callable bonds. And then lower coupon bonds. So if today's market average rate, we'll call it 4.50 to 5%, If we buy a 1% bond, it just affects the duration of that bond because we're buying a much lower coupon in a higher rate environment. That same thing holds true. It's the second bullet point under positive convexity. Positive convexity is that the duration decreases as rates increase. We see that on higher coupon bonds. So if our current rate environment during COVID, when we were at 25 or 50 basis points, we're buying those 5% coupon bonds. Those are positively convex. And then floating rate bonds, because they have the ability to reprice as the market moves up and or down. So Mr. Brown,
Yeah.
go ahead
How,
here.
how do we manage all of the components of duration? The question of the day.
You hire McQueen Financial.
Exactly.
So diversification is key. You do hire McQueen Financial and we will diversify for you. So we want to look at our different asset classes. We want to limit the risk in any specific sector. I started out with don't put your eggs in one basket, and that same thing holds true. We want to look at our term. We want to create a ladder that provides cash flow that's not only made up of static maturities, but as well as amortizing securities. So we have some of those bigger pieces coming back, as well as the monthly P&I. And then we want to look at our risk position. A holistic balance sheet management approach of loans, investments, and liabilities is the best way to look at our duration picture. And that wraps us up for the day.
Excellent. Thank you, Alicia. Thank you, Zach, for your input and a
Yeah.
lot of expertise today. Great information. There's a few questions that came through and we wanted to address. We're not going to be able to get to all of them, but number one is very interesting. We only got about 4 minutes, and I've got several questions. So the first one had to come when we were talking about liquidity. It made me think of Investments 101 webinar and the SLY principle, safety, liquidity, yield. And I want to focus on that liquidity. Because the question comes in is do we recommend a certain percentage of the portfolio or assets to be an HTM? So we're talking about intent here, available for sale versus HTM, and there used to be a game that a lot of people played. Any comments on that?
Sure, I'll definitely opine on it. I prefer 0% in HTM. I know some clients switched their positions and moved new purchases into HTM given the unrealized losses we were incurring on the balance sheet. However, it has a massive impact on your liquidity. You can't get rid of a bond if there's a liquidity issue. We can't restructure the portfolio if there's a problem. It can cause potential issues in the future. From a liquidity standpoint, when we're calculating liquidity ratios, whether it's AFS or HTM, once it comes due in a year, it's rolling into that same bucket. The majority of the time, the intent to when we purchase that bond is that we are going to hold it to maturity. However, we want to have the flexibility and the availability of that bond to be able to sell it if we need to restructure the portfolio and or down the line to be able to make the institution more money if we have the ability to sell it at a gain or as part of a swap.
Yeah, well said. Thank you. And it really also kind of goes down to how lent out is the institution? Is there really a core percentage of that portfolio that's always going to be there? And that's where you can start maybe thinking about tweaking it. But in general, you really need that liquidity. So
Yep.
really good question. And I hate to say, hey, it depends, right?
It does. It does depend. But yeah.
But there is sometimes. Another really great question came in of, all right, our balance sheet has high NEV sensitivity. What's appropriate with a balance sheet, maybe of the products we talked about, some that maybe that would be from Investments 301 would be appropriate to help off high NEV sensitivity. And I'm thinking myself going into variable rate assets, right? CMOs, asset backs that could be variable, shorter term, thinking about that barbell, but any additional comments on that for the NEV sensitivity?
Yeah, the variable rates would be the ones I would be thinking about as well. It's gonna have a minimal, if any, impact on your rising rate interest rate risk. But if you still want to lock in rates, obviously the shorter the better, right? If you have high NEV sensitivity, if you go out and do a mortgage-backed security or a long fixed rate asset or investment, it's gonna have a bit greater impact on your NEV sensitivity in that rising rate scenario.
Yeah. Cool. Yep. And there's are other little things, little tweaks that don't have as much impact, like coupon size, right? Your higher coupons are going to have a lower, slightly lower duration than a same maturity, lower coupon type thing as well. All right. We talked about really discouraging negative sensitivity. And we did talk a lot about CMOs, MBS, and a very similar question came in is, hey, if you guys are talking about not having these negatively convex investments, especially in this high rate environment, when are mortgages or CMOs actually appropriate for in a portfolio?
Can I say it depends?
Yeah, you're on the stage.
It really does. It depends. It depends on what our liquidity position looks like. It depends on what our balance sheet looks like. It depends on what our investment portfolio looks like. When interest rates were, I'm going to say low, and we all know how those 3.5, 15-year mortgages paid, like we never expected them to pay because mortgage rates came down. If we put on right now 6 and 7% mortgages, they're highly negatively convex because we all know that as soon as rates hit 5% again, everybody's going to go back out and refinance. So it really depends on how our balance sheet is structured as a whole, what the expectations for the market are, and what the current market environment looks like.
Yeah, well said. Absolutely. Yeah, the investment portfolio, this is 201, is a tool for managing interest rate risk for earnings. We want to manage it to that base SLY principle, safety, liquidity, yield last, but it's the thing that you can really control your interest rate risk sensitivity. And that's what you really should be using that portfolio for. We can't control the flow of our deposits from our customers. We can't control how fast borrowers repay us. So but the investment portfolio can really be designed for this. So great comments, great answers. I wanted to say, hey, thank you to everybody for participating. We had a great time. We hope you did as well. In case you missed anything or want to have a repeat on this, today's webinar is posted on our webinar section on our website, McQueen Financial's website. In this section, you'll also find previous webinars as well as a list of future webinars that we'll be holding as well. Please share this section with various team members within your organization so they can learn, develop, explore different areas and topics to impact your organization so they can grow as well. So check that out. Our next one is on June 11th. It's a mid-year economic webinar. It's going to be it's going to be short, it's succinct, and appropriate for you guys. Zach Brown, Alicia Bradley, great job. Thank you for today's knowledge and sharing it with us, and appreciate that, as well as everybody else is on the webinar. Thank you for supporting us and the partnership that we have.
You're welcome. Everybody have a fantastic afternoon.
Thank you.